Right. And so we're looking at a market. I think it's really interesting. I think there's a lot of contrarian ideas packed in here. I think one is a relative optimism about triple B and double B credit right now. I think what I'm hearing from you is that, historically buying that type of credit, owning it through the cycle, you've gotten paid. In fact, it seems like what you're saying is you actually, in some cases, earn more than their yield. And right now, when spreads are this wide, walk me through the math of if this recession normalizes, if spreads go back to normal, and you buy say a 6 or a 7% yielding, double B bond, what are you looking at from a total return perspective?
Yeah, if you're looking at it, say a 6% bond that you buy, and let's say the treasury component of that is, we'll call it 1%, and so your spread is 500, right? 500 over treasuries. Well, I mean, historically, double Bs have really traded in the 250 range, call it, right? So you have 150 basis points of tightening potential over 2 years. Let's call it 75 basis points a year from spread tightening.
Is that 250? I mean, sorry, 500.
Yeah, so there's 250, 125 of spread tightening per
each
year.
Yeah.
Each year, yeah. And let's say the average duration in the high yield market is sort of 4 or 5. That's just a measure of sensitivity to change. We'll call it sensitivity to change in yield, right? So it's a 4, but in addition to your 6%, every year you're earning an extra 4%. So you're getting on average 10% returns without anything else happening potentially, and you can get much higher than that, right? So when we do the calculations, we're getting sort of we'd estimate, and this is obviously just an estimate, that you have potential to make, teens returns annualized on relatively safe credit. And that seems to us to be a very, very good opportunity. But whereas if you think about equities, I think when we do the math right now, I think equities do have a lot of upside from recessions, and you can talk about this, but that opportunity doesn't usually present itself for another few months once you've had the initial sell-off.
Yeah, that's right. And I think the other thing that I would note is about valuation levels. We're coming into this crisis. We've had a very unusual market, or maybe a market that looks a lot like 99, 2000 in some ways, where you had a few corners of the market that were really, really overpriced, or from my perspective, overpriced, right? You had large growth stocks trading at multiples near all-time highs. The only times we'd reached multiples like that in large U.S. growth names were 99 and 73 or so. And yet, in contrast, small value and even large value names were trading at pretty historically average valuations, right? So very normal. The large growth component was just trading at these crazy prices. And then you had international equities trading, at a discount to long-term averages. So just this pockets of the market that were really overvalued. And of course, private equity, value like large growth, which is a pretty scary thing, given that those are much smaller companies with a lot more debt. But historically, I think if you look at a 2000 or 2001 scenario, I think a lot of the wisdom of the past decade has been just buy an S&P 500 index fund, and you'll be fine. Coming out of that 2000, 2001, period, Greg, if you start in September 01, should you bought the S&P 500 or should you bought corporate credit? Where would you have done better, and what sort of played out from there?
And it really depends on the crisis, but the themes that sort of come out across all the crises are that the S&P 500 versus the Russell, it's actually the Russell that comes back first. It's actually smaller stocks that come back first, not the S&P, and especially in the 2000 timeframe when those valuations were so high that that was the S&P 500 that really took the brunt of it. In all cases, though, it's really the contractual obligations, the corporate credit obligations, where it's much easier for investors, and it makes sense, right? It's just much easier for investors to wrap their hands around what's going on. You've got a bond in a company, you sort of figure out what it's going to pay. Most of these investors are probably buying it for the yield, right? They're not actually playing for the upside, but because it's a sort of an obvious and easier play, it corrects much more quickly. So it's a much more understandable problem for most investors, and it's also a lower risk way to play the recovery. So I think it attracts a lot more attention faster.
Early on, yeah.